Good evening, everyone. My name is Gil Ben Hur. I'm from the Fiverr, the 5%ers Trading Fund. Um, and today we begin a series of webinars about the story of the markets. Many of you that are struggling in your learning of how to read the market, I have a very good news for you. The market makes a lot of sense. And if we only know what we want to read out from the outputs of the market, um, from the charts, we can read the story of the market. And with that, we can calculate our ways in a very reasonable way, and we can trade and make good profits and eliminate the random factor that many systems provide to us. Um, we will talk in many, we will throw into the table many terms like order flow, like supply and demand, like price action. They all are really combined into one methodology that should make the reading of what's going on in the market make sense, and from that on you can apply it to any trading style, to any market that you work with. You can apply it to the Forex or to the commodities, stocks, anything with a lot of liquidity in it, any kind of market, it's going to work out for you. Any time frame, any type of trading, you can do scalping, you can do swing, you can do long term, you can do intraday, whatever you would want to trade, whatever your personality let you trade. If you have the knowledge of how to read the market in the order flow way, you can add the odds into your favors. So let's begin, and we planned out for you for a series of 4 webinars. Today we'll cover the very basics. I urge you to sign up for the next 3 sessions every Tuesday around the same time. And when you and after that, after the 4th session, you will be having pretty much good idea of what to expect from reading the market. You will not be a professional trader if it's your first time to get to know this material, but it's a very good beginning in your trading learning curve. Okay, so let's begin. First, about me. My name is Gil Ben Hur, and I'm trading currencies since 2007, but only in 2012, after I mastered for about a year before trading supply and demand and order flow and advanced price action. That was the key point for me to start to trade for a living, and I'm doing so since 2012. I was a senior partner with RTM. It's a price action community where we were providing free education and a platform for alike traders to gather around and discuss the understanding of the markets. We did a lot of great stuff. We developed a lot of good quality education, and we created a wonderful community of traders. Today, RTM took a different path. You can still join it, but it's a subscription or a paid website. I'm not involved anymore, but it's still one of the best places to get your knowledge in trading. So I recommend. Um, During my time since 2012, I was a fund manager. I was spent a lot of time in teaching and in educating traders, because I believe the best way to learn yourself is to be a teacher, and this is why I spend my efforts and time to share my knowledge and to um, refine my trading definition by teaching. So many times I get this question: if you're a good trader, why are you being a coach, or why are you being an educator? It's a very annoying question that being asked over and over. And I must tell you, and you can ask any educator that you'll meet in the future, that teaching is the best rewarding and is the best learning uh, thing that you can experience. So for me, being a teacher was just to enhance my own trading, and this is why I love it so much. Just refining my ways in trading, and it made me a better trader. So this is why I love teaching, and I urge you, once you master anything, just go and teach, and you find out yourself how it is. And in the past 2 years, I founded the 5%ers Trading Fund, which is actually a trading fund made for experienced traders. And in this fund, we invite traders, experienced Forex traders, to trade for the fund. Anyone that's proved himself as a good, profitable, and reliable trader, we will provide him the capital. He will provide the talent and the work on the account, and we will split the outcome together. We take the full risk for any losses, the fund, while the trader just come and trade, and if the outcome is profits, we share the profits. If the outcome are losses, only the fund take the losses. So that's the deal. We do it in the past 2 years, and only recently we extended our reach globally in the internet as the Fivers, and you can find us in this website if you want to learn more about what we do and what we offer. All right. So one more thing that beside that we provide money for traders to trade for us. We also provide unparalleled growth scheme, which actually we double the account and double the profit potential of a trader for just 10%, for every 10% that is making for us. So let's say we begin with a $50,000 account. When the account is at 55,000 equity value, we will double it and we will make it a 100K account. So by that, we also provide a great vision for good traders to grow and to scale their performance and their income potential. So this is what we do. Let's start talking what we're going to do today. We will do introduction to what is order flow. I will explain to you how things work behind the scene in the markets, in any market, and why order flow is the core and basic idea that if we understand how it works and how it stimulates the markets, then we have the best understanding of the market itself. So I will explain and try to reason why learning this concept is the only thing that you would need to actually know in the market before you go to tactics. I mean, strategically, understanding order flow is the most important concept in understanding the market if you want to trade and if you want to define what levels you're going to trade on. We're going to mention demand and supply. You probably heard it. It's a buzzword that goes on for many years now. It's part of order flow, and the theory about supply and demand is there's like every concept has the too simplistic way of trading. So also supply and demand, they have a very simplistic way of how to trade it. I will show it for you today, and we will define how you would take supply and demand in a simplistic way, and you can and how you can develop create a trading plan with that. But I must tell you that it's not the full story. It's not the full reading that you should do on the market. So here's my my alert to you. It's just too simplistic of what we're going to do today, and you have to have a bigger reading on the market with more concepts in it. So today, just the basic, just the introduction. Let's begin. Okay, the story of the market. Why do I call it the story of the market? It's because the market is narrated by price change over time. Meaning every time that price change, even now, it's being recorded and being printed somewhere on the history of chart. And this is actually the only way that the market writes itself. Okay, so if you try to think about it, we want to make sense out of what's been written. It's the history of what price did. Okay, price were ranging, or price was breaking up or breaking down, or just returning to a place, or fake outs and everything like this. This is what price do, and it's written in a chart way on by bars and candlesticks and in lines and in many ways, and we should know how to take this history written and read it to ourselves and try to read out something. But what is that something that we want to read? What is the story? What will be the essence of the reading? What will make us give us any benefit in understanding if price was ranging or breaking or faking or whatever. Okay? We have to understand that when price change of any equity, okay, commodity, stock, whatever, it's an outcome of all the collective participants, and some of them are wanting to buy the assets. Some of them want to sell the assets. The net is the collective decision of what is the outcome of the buyers and the sellers. And this is what we're going to read. Who wins at any level of price? Who win, the buyers or the seller? And if we understand who won before at a certain level, then we can start to assume and understand what will be happening when price return to the same level. And in few moments you will understand why that is so. Okay, so price will change when one side orders exceed the others, meaning that if there are more buyers than sellers at a certain price level, then price will go up. Why is that happening? In a few minutes you will know. And when we're looking at the charts, this is what we're reading. We want to read the story, the everlasting battle between the buyers and the sellers. We don't really care at that moment. We don't really care who are they, who are the majority, and what's their motivation, because their motivation and the collective decision for price to go up, let's say, it's a combination of so many participants. Some of them are big hedge funds, some of them are small retail traders like us. You don't know, some of them are because Trump tweets something at the same time. You don't know. There's so many reasons why price would go up or down and why people will jump on the train on the way up or down. We don't really care, but the only thing that we should care is where do we read from the chart, where will be the next place where a lot of orders are waiting for us to take, and this is what we'll start learning today. So here are two kinds of markets, but are they any different at all? What do you think? Okay. Summer says no, and both sell and buy, and Barak say yes, and both are supply and demand, Ronald says. Okay, in my idea, these two markets are pretty much the same, and I explain. In both markets, in the financial markets and in the vegetable market, the very simple and basic and ancient kind of market, we have a few conditions to make it a market. We need a buyers with a commodity that he wants to sell. Okay, so we have the stock, and we have or we have the tomato or the onion, and we have the seller that's punching a price, and we also have a buyer. We have a willing buyers that is willing to buy this tomato at the specified price. Okay, the same thing with the stock markets. In the stock markets, we have a share, we have an equity, we have a paper that somebody wants to buy and someone wants to share. There is no tick in the market. There's no price, official price to an equity if there weren't two sides to the deal. If there's always somebody who sell and somebody who buy that makes the next price. Okay, so it's pretty much the same. It's either you sell stocks, you sell contracts, you sell houses, you sell tomatoes, you sell whatever. It's always a balance between buyers and sellers, between how much supply, how much commodity is available in relation of how many people demanding this commodity. Okay, so it's pretty much the same. And let's see it in another perspective. Let's understand what is supply and demand. When let's take the lemonade case. If we see on the right side, we see in a festival, this guy, he won the auction and he's the only person that provide on a hot day cold lemonade in a place where many people are hanging out. He's the only one that's selling. He's actually doing the best service to himself because he's having a limited supply of lemonade to many people that demanding his products. Okay, so we have this situation where we call it high demand with low supply. And let's say the manager of the festival would not limit this guy with the price. He could now charge $10, okay, and he can exaggerate with the price of the lemonade, and whoever can afford himself to buy it probably will buy it. Maybe less people, but he can afford it because maybe he can double the price and still get customers, and he will play with the price until he gets the balance between how much supply he wants to get rid of and how many potential clients that would come at the same price. So at the right picture represent high demand against low supply. The left picture show the really opposite. These two cute girls, they made a lot of effort. They squeezed the lemon. They also baked cookies, but nobody is aligning in their shop. And they now are willing to sell the lemonade or even give it for free, but not just spill it on the grass later on. They would want to at least make something out of it. So they represent a situation where there's a lot of supply, but nobody is demanding it. Okay, so what do you think will happen in both cases? In the situation where you have a lot of supply but no demand, price will go lower until you find somebody who is willing to buy it very, very cheap. Okay, when you have the opposite situation, the seller can try and raise the price until he gets a balance of enough people buying his commodity, and he's going to make a lot of profit, a better profit for the same product. Okay, now let's look at it in a sorry. Okay. So let's try to see it in a more schematic way. We have the axis of price and the axis of demand and supply. Okay, while we have enough equivalent demand for buying the product, then no side of the deal would try to push for a better situation for himself, meaning that the seller of the tomato will not try to raise the price because maybe he will scare the only customer that he has, and the only customer will not try to get the tomato for less because he would not get the commodity that he needs. Okay, so in that case, when we have equivalent situation between demand and supply, between buyers and sellers, price will stay at the same level that it was before, and we call this situation a balance situation. Okay, but when more people are coming up and they going to fight on one tomato, meaning that there's more demand than supply, then the seller will have the opportunity to try and bring the price up, because he can auction the traders. He can auction the same product for the buyers and make more profit. So when there's more demand and less commodity, then price will go up. But at the same time, the seller still wants to sell. So if he see that there's a lot of demand, he will bring more products into the market, and now he brings the situation again to a balanced situation where there's enough products to the demand that he has, and then price will stay again at balance, and it will not change. It will not change at a higher level, but it's still not changing. Okay, so and the next time is when not enough people want to buy the product, and the product stays on the shelves, and the sellers must get rid of the product, and he will get the price down, so more people will feel the opportunity to buy the product at discount. So price will go down when there's a low demand for high supply. Okay. Now let's see what's going on in the market. The past few examples were just trying to bring examples from life as we know it, and to understand what's going on. But now let's see how it works in the exchange, in the financial exchange, in the market maker point of view. When we file our orders into through our brokers to the exchange, what actually happened is similar to these two piles of papers. Okay, say that in the morning before the exchange opens, everyone has half an hour or 1 hour, depends on the exchange, to send their morning orders before the trade begins. So the yellow line represents a certain price level, and at that certain price level, we had a situation where many people are filing orders where they want to buy the equity, they want to buy the share, and less people and less orders are there to sell. What do you think will happen when the bell rings and the trading begins on the market? The first thing that will happen is that the first action that the exchange will do, they will start matching the trades. So let's say we have here orders for 100 shares of a stock, okay? And this is the 100 shares to buy, and this is the 100 share for sell. So the exchange, the market maker, will start matching and making trades for 100 shares of people want to sell with people who wants to buy. Okay. Once these 100 shares are gone and this pile is empty, all the remaining of these orders are staying there. Okay, and there's no sellers. So if there's no sellers for a lot of buyers, you cannot make any trades, okay, because nobody is going to sell anything at that specific level. So what the exchange will do, exactly the same as the tomato seller would do. He will rise the price, get the price, drive the price a little higher, maybe a little higher, he will find new willing sellers for the same thing. Once he gets to a place where he can create more matching trades, this is what the market wants. They want to make to match traders, buyers and sellers. Okay, so whenever they find them is where the price would go. So this is actually what's going on in the market. So when we have a bigger pile of buys than sells, we call this situation imbalance. It's imbalance in the order flow that's waiting on a specific price level. And imbalance is what we like as traders. We want price to move in a certain direction. Okay? So what we want to read in the charts is where are the situations where we have this imbalance, because we know that these the pile of the sellers in that situation will be gone, and all these remaining orders will stay there and wait for a future execution. So so that's how it works behind the scene, and because this is how it work, and this is how we visualize things, we assume that when let's call this specific price $100. Okay, so in $100, when price moved up and when it comes back to $100 per share, we assume that these remaining orders that could not be filled before because there weren't any sellers, when price will get back there later on in the future, these orders are just sitting there and waiting to be executed. And so this is actually what we want to read from the chart. We want to see where are these places where the collective decision of the market participants were made, and this is where we want to place our future orders. This is where we want to enter in a smart way to the market. Okay, so let's see how it's look in the chart. So So in the charts, it's when we have nothing on the charts, it's just for many new traders, it's look like just a mess, just a zigzags of lines with no with not that's not really making sense. But when we start looking for where decisions were made in the market and what we've learned so far, we can start working it out. So let's do it together. What we're looking for in this naked chart is where was the collective decision of the participant to drive price in any direction. Okay, so if we look at where price just dropped down very hard in this situation, we can assume that after the price was ranging in this. Does everyone see my cursor? So when, yeah, okay, good. So when price was ranging around this level here, we assumed that there were enough buyers and sellers at this time, but something happened around here. Around here, there were not many buyers anymore, and price was just dropped down. So at this line, we assume as chart readers that that the collective decision of all the participants of the market in that specific commodity, this sample is copper, was that there are more sales orders on the shelf than buying orders, and this is why price went down. So this is where a decision was made. So if we start looking at where decisions were made, here's another situation where price was ranging around this time. We had a lot of trades in here. Buyers and sellers, they all get satisfied and they're getting their orders, and then suddenly here, there's not enough sellers anymore, and price just shooting up, waiting to find more sellers. They find it around here. Okay, so we can see that all these impulsive three candles were a decision of the collective participants of the market. There's more buyers than sellers, and there's a decision of the market participant that to drive price up. And so, and we can go on and on. We can see here another decision for price to go down. Okay, sellers wins our uphand on the buyers, and the opposite goes on. So it's very easy and very simple to just look at the chart and see all these impulsive bars and look where they actually break the range, and this is where the decision to the collective decision, this is the decision point, we call it decision point, that drove price up. And what we assume that happened in that decision point is exactly this situation. The decision point is where one pile is just empty, and the exchange, the broker, has no other there's no other things to do than just bring price to the next level where he can find more sellers to match his buyers. Okay, so this is what happened at these decisions level, and this is the definition of order flow, and this is what we want to read from the market. Okay, So let's just recap what we understand now. If we would know where orders are waiting, okay, in that case, if we have this decision and we know that in this decision all buyers were gone, and we can assume that because all buyers were gone, we still have some remaining sell orders in this decision point, okay, what would be the most obvious thing that we want to do? We know that there are sales orders in this decision point. Okay, so we obviously want to sell this very level, right? Okay, so that's start to bring us some logic in what we want to read from the chart and how we actually use it in our trading. So let's do some practice on how we see how we um, analyze the chart. Okay, so like I said before, we're looking for the impulses. Okay, now we're talking about technique of how to define supply and demand zones. Okay, so it's very easy to see on the eye where price shooting up or shooting down, and we're just going to mark them. Okay, so we take we see shooting down and we see shooting up, so we mark them again and again. We have them all over. Okay, if we go and analyze one of these impulses, we are going to look for where a decision was made for price to start driving into a specific direction. In this case, it's going down. Okay, so where would that be? The first place after price was climbing up and it was ranging around this area, it started broking, and from that on it was just going downwards. So this this break of this candle, I would not name it because they mean nothing, these names for the candles. So when breaking the last candle here, this is the decision that was made for price to go down, and we assume that this is the first price, the first price where the absence of buyers were there. So we assume that we can find enough sales orders that are waiting to be filled for next time that price will return. Okay? Do you follow me? Do you understand the logic that I'm trying to define here? If not, I'll explain it again. Okay. Okay. So most of you understand it, so we'll continue. Okay, so when price go down, and we can define where, and we can analyze where was that last time that we saw buyers in this situation, enough buyers that could effectively bring price up, like we see here. Okay, we see that price goes up, always making higher high, and then here it's the last time that was made higher high. From now on, it's only lower lows. Okay, and this is the break of the higher highs and series, and so we can assume that from here we don't have any buyers anymore, and if we don't have any buyers anymore, we probably have a lot of sellers in this situation. Okay, so we just mark this decision, and let's see what happened when price got back there after that. So we stretched the same line, the same decision line, and we go all the way, and price was traveling all the way down and was ranging and coming down, and then look what happened when price came back to this decision. Okay, when it came to this decision, price was just reacting to this place, and I'm calling it reacting because it's we're not expecting, we're not at the level now that where we can analyze reversals movement, but it's the beginning of understanding this. We have a reaction to the order flow, to the cells, to the short order flows that are waiting here to be executed because they couldn't be filled when price was dropping. There are leftovers orders that when they come here, technically they being executed and affecting price in a bounce, okay, for a bounce, not for a reversal, but this is explained a lot. And if you start seeing the scenario that happened in these drawers, like here, if you see this, if you try to visualize what happened in the drawers, then this is actually what happened there. And this is how it works. And see how price came into this level, took the orders, and went down. It affected the price to go down, and we got this bounce. And this is H4 candles. So H4 candles provide you pretty much enough points to take from the market and to make a living only by these bounces. It's enough meat to put on your dish for that. And when price came back later on again, first you see there's a new micro decision that was made here, and it was affecting here, and when price came inside the zone that we call it a supply zone, it's still affecting. We still see a lot of resistance by the sellers that push back price down, and it's still affecting. And then on the third time it tried to penetrate, it still push it down. So we can realize, we can say out loud the story that we see here, the story of the buyers and the sellers, and we can understand that we have orders of sellers trying to affect here, and they making significance in this area, and then eventually pushing price much lower afterwards. Okay. Okay, so let's continue. Okay. We have a request to show how we define the decision again. So like I showed you, this is a supply zone that we were analyzing. Here we have another demand zone. We see that a little impulsive, and we see that price was breaking here and going on impulsive and start rising up. And when price came back to this decision, it's really wired. It's a hot spot where price just being pushing up, and there's and we can assume, we can read from the chart that we have strong buying orders with less people willing to sell this. So this would mean that price would eventually go up by the market. So price is just being playing on this decision for a while, pushing up and then making higher high, and then again coming up here and then making bigger higher high. Okay, so we can see that the concept is starting to make sense, I hope, for you. Okay, then we have another decision for price to go down. So we assume that we have sales orders waiting to be filled that they couldn't be filled before the drop down. So when price touches and testing this place again, then it's just bouncing at the first time again on H4. And if you would do it on a daily chart or a weekly chart, these will bring you plenty of points to take from the market, and see how precise this level works. Okay, and then again and again, and then after it was taking enough from what's in the shelf, price is free to go. It's consumed all the orders that were in the shelf and in the drawer, and price is free to break the level. So when we try to read from the chart the order flow, it would give us few ideas, few concepts of what price may do next time it meets. We can see if price never tested the decision level before, we can assume that price will bounce it, on it. If price was testing already, we can assume that maybe there are no more left orders in there, and we can assume that the zone is consumed and probably price is ready to break that level if it would come again there. Okay, so when we analyze where we have order flows, we can also analyze where order flow was consumed, and then we can calculate our ways if we want to take a level on a second test or in a third test, because we can start assuming that the order flow is being taken already, and maybe we don't want to risk our trades on a second or third test of a specific level. So it's also give us clues of how to stay away from trouble in the market if we understand what's going on on these draws. If we just visualize what happened in these levels in terms of the draws, then we can stay out of trouble and we can take opportunities. Okay? Okay. Another great feature when we trade this way is that we get high reward and low risk trading, because what happened is that we're waiting for price to come to our level, to the level that we're interested in. We're not chasing the market. We're letting the market coming all the way to where we want to trade it. Okay? And what does that mean is that we never buy on high. We buy only when price is very cheap. And we never sell at cheap. We always sell when it's expensive. Okay? Because we know we always wait for price. And because we have the order flow give us a price action, a price pattern definition for what would be our entry and what would be our risk. Okay, let's talk about this supply zone. We have this decision for price to go down, and we assume that that in that place we have a lot of selling orders, so that would be our entry. The risk would be the whole place, the whole zone from where we had the first sellers, okay, just above it. That would define our risk. So if we want to create a trade a trade structure, then we would have then price already plot for us the trade that we're going to take. The entry would be at the level of the decision, and the risk, meaning the stop loss, will be just above the last trade that was in that range. Okay, so we already have a definition for the risk, for the entry, and the exit at loss if that happened. Okay, so let's measure what would be the outcome. Let's take this demand zone, and we have the definition of start trading on the decision level, and that would be our buying level, and our risk will be just below the lowest trade that was on that zone. So that would be our where we place our stop loss. And let's call the whole zone from buy to stop loss, let's call it a risk unit. Okay? and by that, let's see what was the outcome in terms of what price did. I'm not saying that we would know how to exit specific at that place, but this is what price did. This is the full potential. I'm not saying we have the knowledge to exit here. We do if we go over more advanced stuff, but let's just understand the potential. Okay, so if that's a risk level from buy to stop loss, we had approximately 3 times of the risk units to the actual reward that price made. Okay, we're not, yeah, it's 3 R's. It's a 3-to-1 risk reward ratio. Okay, so so that is the suite that only traders that can define their trades ahead, pre-planned it by price action, letting price define the trade structure for you, and you wait and you have the patience and you're not chasing breakouts that can turn out to be fake outs. You just wait for price. You have your risk predefined, and usually because you buy at slow, because you buy at dips, you have more meat to take from the market, and meaning that you can improve your risk reward ratio from taking it. If we wait for the next um, touch on the same level, we already got 5-to-1 risk reward, and if we can and if you learn the more advanced stuff, you can get into much more, because if you would know how to get this trade from here, you would that would be maybe almost 9-to-1. Okay, so you can get to these really incredible ratio numbers, and it's and it's not exaggerated to ask. Same thing on the sell. We have this decision, we have the last trade, just above it will be our stop loss, and that would be define our risk unit. Okay, so we have a risk unit, and let's see what happened when price first came and hit the entry level, the decision level. Price would go all the way up here, and it would get us 3-to-1. So it's pretty much easy to request from the market 3-to-1, 2-to-1, 5-to-1 risk reward if we just play out order flow and decision making and decision points in the markets. Okay. So what did we do today? We understand that the market is not random. We understand that whatever written in the chart is for us to read, and if only we know what we want to read from the charts. And the thing that we want to read from the charts are where are the orders are waiting for us. Okay, so so when we read where the orders, if we want to read that where the orders are waiting for us, then we can find a lot of good sense in the market after all. The market is driven by the colliding motivation, by the opposite motivation of buyers and sellers, and this is the story that we want to read. We're going to, from now on, you're going to start looking at the market in terms of where are the buyers, where are the sellers, who won, what was the outcome, did it break new levels, did it make levels, did it print new levels, did they leave order flow waiting for me to take in the next time it's going to be tested. All these questions will create for you a new plot for what happened in the assets that you analyze, and from that on you can just take advantage and trade correct on that. And so this is what we want to read. The story is written on charts, and we read their story from there, and we and what we've learned today is that that in the decisions that the collective participant made is where we want to start trading. Okay, so and of course the most important assumption is the drawers concept is where decision made in the market is where we assume that there are leftover orders, and these left orders will be executed next time price will test that level. So this is what we're looking for when we're out there to try to hunt our next trade. Okay, so this is it for today. I will go over a few questions here if I see something. You can write me questions. If not, next time we'll meet, we'll talk about how we can analyze where there are no supply or non-event, where there are no, where are the places where we have absence of order flows, and this is the opportunity for where price can go through, and by that we can also take the right direction in the market when we enter. We can also understand some situation that we didn't understand before, and we can stay out of trouble. And so this is will be next time, and these are great tools for so I really recommend that you come next week. Okay, let me read some question. Is supply zone only marked on one candle? No, supply zone is not marked on one candle. Next time we'll go over this. You actually what you do, you take the whole range. You see where the break was made, where the decision was made, and from that on you saw the impulsive, and you find what makes you what makes most sense in your eye. You mark it and you test it, and eventually you'll get the skill of how to refine this level. So it's not this. And one thing I really have to mention to all of you, although the market is written in candles, and candles are usually um, are a sample of time, meaning that there's a candle for 1 hour, candle for 1 day, candle for 1 minute. It's just a random decision. It could be a candle of 2.5 minutes. Okay, so it's the candle itself has no significance. The price has the significance, but so don't consider any candle patterns and all kind of names put to that. Try to understand what happened in price, and it will make your life and your trading much easier if you don't learn by heart the doji and the Morningstar and all these names. They mean nothing if you don't understand what happened in the order flow, because this is what drives price to go up, down, or range, or whatever. If you understand that, you don't need names for that. And once you understand that, you would know why they said that doji or a falling or a shooting star or whatever they call it are considered to act in a specific way. Why they say that you should trade a hammer like you trade a hammer. Okay, so just skip that. Try to understand the market in that sense, and it will just save you a lot of BS material to learn. Okay. Okay. Where do you read order flow? Where do I read order flow? We read the order flow by by finding the decision, by finding the decision point, and on the decision point we assume that order flow is existing there. Okay. When do you know the zone will not hold? Um, we will go over this tomorrow, next week, but it's the spoiler for that. We already said it. When price is testing again and again the level, we assume that there's a consumption of the order flow in that, and then we can assume that price will hold. There are more there are more things to it to do this assessment. We'll go over that in the following meetings. Who could we find equilibrium point? I don't understand this question. I'm sorry. I prefer to trade with a trend when we use supply and demand area. We trade against the trade. It's not really true because we can apply the supply and demand to trade in the context of a bigger time frame, and we can still be on the trend of a bigger time frame and time our entries on the lower time frame by supply and demand. It's if you ever, I don't know if you apply in your trading retracement and going back to the trend and then the pull down. If you apply the understanding of the order flow for the pull down for the retracement, and you can time your entries very precisely on how to return to the trend of the higher time frame. So you can use that. Come back next week. We'll start talking about the higher context of things, and you'll understand how you can make much better than that. Why we cannot find books on supply and demand? The only real reference or Sam Satan on the internet. This kind of trading are not look like popular if we compare to Elliott waves, harmonic patterns, etc. First of all, there's a lot of good information about supply and demand. Second thing is that supply and demand is not the full picture of reading. You have to apply more concepts into supply and demand. Supply and demand really lies in the basics of things, and you really have to understand that. Elliott waves and harmonic patterns, I don't really know. Harmonic patterns, I don't really believe in geometric symmetry in the charts, because the market doesn't work like this. The market is motivation of the real world in that is reflected in the charts. It's wars, it's politics, it's commerce, it's seasons, it's everything but anyone taking rulers and looking for symmetry shapes in the market to draw butterflies and triangles. So I don't really get the thing with harmonic patterns. But you can trade whatever you want. I'm looking for something that makes sense for me. What I'm looking for in the market is what I'm teaching you now, and this is what works for me the best. How many pips the price have to rise or fall to consider to consider a turning point. There's no you never measure things. You never measure results by pips or by points. You measure results by the outcome. If a price was reacting to a level, to let's say to a demand level, and it broke new supply, then it has a significance, and then you can say, okay, there was a reaction to a specific level that resulted with breaking the opposite level. Then you have something contributed to your story, and with that you can consider it a turning point. Okay, if it didn't break, then it's another sentence that you can read out from the market, and then you can think how you would like to react to that sentence, to that information that the chart provides you. So it's not, we're not counting pips or points. We're looking for efforts versus results in the market. Okay, this is where can you get recorded? Okay, he left, but I think in a day or two you will have the recorded here on investing.com website. You can rewatch it. Okay, I got lost with everything. Okay, I think most of the questions are we were discussing already. Okay, so thank you for coming up today, and don't forget to sign up for next week, and we'll go deeper into that concept, and you will put your hands on new tools and new ideas of how you can improve your trading and your understanding in the market. So thank you so much for showing up today, and hoping you're going to have a great upcoming week. Wishing you success in trading, and see you next week. Bye-bye.